You probably driven past one of those abandoned warehouses and wondered why no one is making money there. The reality is most large investors avoid these type of properties because they are hard to finance. But with the right strategy, even you can buy one of these and make a lot of money without putting down a lot of cash up front. In this video, I'm gonna teach you how to do it in 5 simple steps. Stay tuned to find out. Okay, so let's deep dive into the warehouse flipping strategy. Okay, technically you can use this strategy to retail or office, maybe other kind of commercial properties, but I prefer to do it on industrial warehouses because of 2 reasons. First reason, you have more options for tenants on industrial than, for example, on retail. Think about it. If you find a big retail property abandoned, your tenant options are reduced to maybe Walmart, maybe Target, or maybe 3 or 4 other options. But if you find a warehouse, industrial warehouse, there are plenty of industrial companies or tenants that can lease up that space. And the other, it's easier to find industrial warehouses than retail properties that are abandoned or maybe office. So that's what I prefer on industrial. So let's deep dive. The first point of the strategy, the first step, is to find a warehouse, a vacant warehouse. Okay, for me, the most successful strategy or the most successful way to do it is driving by your city, just exploring. Just go to industrial areas in your city and explore the areas, and you will see maybe some properties that may seem vacant. The other strategy is using software like CoStar, Craigslist, LoopNet, these websites that you can find abandoned properties. You can filter up by no tenants in the property. The software only shows you vacant properties. And the other thing is a real estate agent. You can find a real estate agent that specializes in this type of properties, and you can tell him all the features you are looking for this kind of properties. And this is important. You have to focus on properties that were owner occupied, because maybe you found an abandoned property, but it is from a fund or from a institutional investor. They are on the rent business, so you will not get as a good deal as if you negotiate with an owner. So you have to find properties that maybe the company moved to another city because they open a new market and they decide to move their production facilities, and they just have that property vacant and seated, and they want to sell the property. So they are going to sell you, but they are not in the rental business, so you probably get a better deal with owners than with institutional investors that are there for the rents business. Okay, the second step is you have to write the letter of intent or your offer, and you have to negotiate in this an option period or due diligence, where you will be looking for all the things you have to look in a property, like the roof. If you have to change the roof, maybe you have to change the AC, that kind of things. And you maybe can start looking for tenants. You cannot sign a lease agreement because you are not already the owner, but maybe you can start looking from your list of past tenants or clients and look if they are interested in leasing that property. The second thing you have to focus is on the bridge loan contingents. You have to write this offer to be contingent on getting a bridge loan. What is a bridge loan? A bridge loan is basically a hard money loan for commercial. There are other the most common type of loans for commercial are perm loans, and those loans, they require you to have a cash flow. The property needs to be cash flowing. So that's the last type of loan you ask when you have a commercial property, because you first have to rent it out. But if you are looking for a vacant property, you better look for a bridge loan, okay? Because they don't ask you for the property to be rented out. They will give you a higher rate maybe, but they will not ask you for the property to be cash flowing. The third thing is you have to get seller financing. Why? Because this bridge loan, they as you probably already know, as the hard money loans, that the loan to value is 70%. That means they will not lend you all the money, so you have to get the other 30%. So the bridge loan works in kind of the same way. So you have to negotiate with the seller to pay the other 30% of the value of the property, but with seller financing. Maybe you get a second mortgage. So the first position will be for the bridge loan, and then the seller, you will pay the other 30% maybe in 3 years. This is very important to negotiate it well, because maybe, let's say the seller is selling the property for 1 million. So you can say, okay, I will actually give you more than 1 million. I will give you $1,100,000, but I will pay you the rest in 3 years, no interest. You just put the extra price in the agreement, in the cost of the property, and you put no interest, and you make a balloon payment after 3 years, or maybe 2 years. At least you will need 2 years to do this. So maybe you negotiate a higher price for the property, but you will pay at the end of the third year. Okay, so that way you can negotiate the other money that you are missing for the bridge loan. And you have to do your due diligence to find out what improvements do you need. If you want to subdivide the property and rent to multiple tenants, maybe you have to add 2 extra doors. So you have to find out how much money will you need and what improvements do you need to build in order to subdivide or to rent out the property. Maybe you have to replace the AC, or maybe you have to replace the roof. Okay, so this is the time to do it. After writing the offer, you are on the due diligence period and in the finance period. So you have to go with the bank to ask for the bridge loan. They will not ask you many things, as I told you. They will only ask you for the location on the property, and they will go see the property. It works kind of the same way as a hard money. So they will find the market rents of the property, and they will find also the cap rate of the area, and they will figure out the value of the property with those numbers. So you don't have to do much things, but they will basically find out the value of the property by themselves, and then they will tell you how much they will lend you, but will not be more in most of the cases than 70%. The other thing is the due diligence. You have to find out the title, the normal due diligence for a commercial property, the environmental. You have to run some reports to find out if there's no environmental problems with the property, and you have to find out how much are the costs to improve the property. Maybe you have to replace the roof or something that costs a lot of money. So this is the time to find out, and then if you find maybe to replace the roof or something like that, because you are still in your option period, you can still negotiate with the seller. Maybe the seller accepts to make those improvements. The fourth step is to add value. How do you add value to commercial properties? There's only 2 ways. One way is to increase the rent, and the second way is to reduce the cap rate. Okay? To increase the rent, we can, as the last video I explained you, I will show you here. my last video where I explained you how to subdivide an industrial property. You can subdivide the entire property and rent it out to multiple tenants. That way you can ask for more rent than the market rent, that if you rent it for only one tenant. For example, if you will rent the entire property without making any improvements, maybe let's say in this market you will get $5. Okay, but if you subdivide and rent to multiple tenants, maybe you will get let's say $8. Okay, because the smaller the space, the bigger the rent. The other way you can increase the rents is with top market rents. Maybe this property was rented before the seller was selling the property, or the properties around them they are renting for maybe $5, and maybe this property was rented before $3, let's say. So you can increase to market rents $2. Okay, that's another way to do it, but not very common here, because as I told you, you are looking for vacant properties. You will not get that number for the previous rent they were asking for. So the third point is with tenant improvements. Okay, and this comes to the cap rate, the second type of way you can increase the value of the property. Because if you make, as in house flipping, if you make some renovations, if you make the property more beautiful, okay, you can get better tenants. Okay, and that better tenants means less risk for investors, and that means that translates to cap rate lower. Okay, it's not the same having a large business like, let's say, like Walmart. It's not the same risk for an investor than having a tenant like a mom and pop business, like a furniture shop or automotive shop or other local businesses. If you can improve the property and make it prone to more qualified or more credit tenants, that reduces your cap rate. But you need money here. You need money. At least if you cannot negotiate for the seller to pay for those improvements, you will need to put some money. So the last step, the fifth step, is to refinance. Okay, so after you add value and you get a new tenants, or maybe you subdivide and rent to multiple tenants, and you are now having more cash flow, okay, or you reduce the cap rate, you increase the value of the property. So that means you can now refinance. You can now refinance because the property is worth more. Okay, and then you can refinance in several ways, but because remember, you have, in this example, you have two loans. You have the bridge loan in the first position, and you have the seller finance on the second position. There's two ways. First, you only take one loan. You only take the perm loan, and with that loan you refinance the bridge and the seller. Okay, both loans you refinance. And the second way is you get two loans. You get a perm loan, and you get a mezzanine loan for the other amount of money you are owing to the seller. Or maybe this works if you take a perm loan, but it's not enough money to pay for the seller. Maybe the seller you owe, maybe let's say $300,000, but if you refinance only the perm loan, you end up owning $100,000. You pay $2,000, but you still owe $100,000. So in that case, you have to take a second loan. A mezzanine loan, it's a loan on the second position, or maybe you pledge some kind of LLC memberships or corporation memberships that holds the property, and they give you money, but the rates are usually higher than in the perm loan. So if we are talking about, let's say, 7% for a perm loan, maybe a mezzanine loan will be around 10, 11, or maybe 12%. Okay, so the best is to refinance only with the perm loan, because this is cheaper. Okay, but sometimes the money is not enough to pay the seller. And remember, you have to pay the seller at the third year or maybe the second year. So you can refinance, or maybe you can sell. If you don't want to mess it up, you don't want to get in trouble getting refinancing, you can sell, and that way you pay with that money, you pay the seller and you pay the bridge loan, okay, and you make some profit. The cons of this, it's you have to pay taxes for sure. At least there's way you cannot pay taxes selling a property. I will explain you in next videos. There's something called 1031 exchange, but if you don't do 1031 exchange, you end up paying taxes. I very like to refinance properties. Okay, so let's do the math for the warehouse flipping strategy. Here we have the information for the sale of the property. We are purchasing an industrial warehouse, and this is an old warehouse, maybe Class C warehouse, and the cap rate will be about 10%. Okay, so the list price for this property, the seller was list the property for $1,250,000, but we offer more. We offer $1,400,000. Why? Because we want seller financing. So we ask the seller if we can pay just a little bit of money, or maybe less money down, and then after 3 years we are paying the rest of the property, and in exchange of that we are offering $150,000 more. So this will be like the interest we are paying for that kind of financing, but we are paying at the end of the deal, at the end of the 3 years while we stay in the property. And then we have the size of the property. It's 25,000 square feet. Okay, the market rents for this property around the area are around, remember this property was vacant, so we don't know a number for the rents, but we can find the rents for properties surrounding that area, and we found that that will be around $5 per square feet. The bridge loan rate, we got a bridge loan rate with a 9%, and this is important, interest only. That reduces the monthly payment. Okay, loan to value, it's 7% of market value for this property. What is market value? Ends up to be the list price. So the list price is the market value that the lender calculated for this property. So that will be $1,250,000. Okay, so they will only lend us 70% of that value. That ends up to be $175,000. Okay, and the DSCR they are asking, it's 1.5. The seller financed part of this deal will be the rest. We extract $1,400,000 less this value that the bridge loan is lending us, and the remaining it's a little bit above $500,000. And the monthly payment for this interest-only bridge loan will be $6,562. For the stabilized property, after we decided this property, we are going to subdivide this property into maybe 5 tenants. We have 25,000 square feet. So we decided we may subdivide in 5 tenants, and each tenant will be 500 square feet. And that way we can increase the rent a little bit. We increase the rent to $8 per square feet. We negotiate with all the tenants triple net leases. That means they pay all the expenses. Okay, so that is mostly our profit. Okay, and the monthly income we have for this, it's we multiply the rent per square feet by the total area of the property and divide by 12 months, and we get $16,667. Okay, so we are going to check if this amount it's above the DSCR, the bridge loan is asking. So they ask for 1.5, and we have a cash flow of 16,000, and we divide to the monthly payment of the bridge loan. Remember, $6,500. So we got 2.5. That is more than the 1.5 the SCR, the bridge loan, is asking us. Okay, so we are good in that. So, but we are now calculating the new value of the property because we want to pay down the property. Okay, so we have this $16,000. We multiply by 12 months and then divide by the cap rate. We have the same cap rate because we only increase the rents. We didn't compress the cap rate, so we end up with the same cap rate. But it's not a big deal because if we divide the cash flow, the net operating income we are having, we divide it by the cap rate, we get the new value of the property. So it ends up to be $2 million. Now we want to refinance with a perm loan. We want to pay the bridge loan and we want to pay the seller as well. So the perm loan, they usually lend us a little bit higher than the bridge loan. Some of them up to 80%, but we are conservative with this and we are on the 70% loan to value. So 70% loan to value, we multiply 2 million by 70% and we get $1,400,000. Remember, this is the amount we owe the bridge loan plus the seller. We owe the full amount of the sale price. Okay, so the new perm loan is lending us the full amount. Okay, so we can pay down the bridge loan and we can pay down the seller at the same time with one loan. So we don't need a mezzanine loan. Okay, so the new perm loan, the interest is a little bit lower than the bridge loan. So we have a 7% interest on that loan. To get the monthly payment for this loan, we multiply amount due by 7% and divide by 12 months and we got $8,000, a little bit more than $8,000. That's our monthly payment for our new loan. Okay, so the DSCR for the perm loan, they are asking us the same, 1.5. Okay, so we are going to check now if we are good with the DSCR. For this, we divide the $16,000. Remember, we get from the rents. We divide by the new monthly payment of the new perm loan, that is $8,167, and we get 2.04 DSCR. So that it's bigger than 1.5 that the perm loan is asking us. Okay, so finally we calculate the money in. How much money we already paid the seller and we already paid the bridge loan. Okay, so now we have only one loan and we are cash flowing. But how much we get from this property? We get $16,000 in rent and we subtract the $8,000 from the monthly payment for the loan, and then we end up with $8,500 money in. That is mostly money in, maybe a little bit more extra cost, but since this is a triple net lease, we don't have to pay taxes and we don't have to pay insurance and that because the tenant will pay for it. So $8,500, it's a lot of money. You can retire with even just one deal. Think about it. So what do you think about this strategy? This is a good way to start investing in commercial real estate with no money down. Do you have any question? Maybe a particular question for this deal or maybe other deal you see on your city? Leave it in the comments. I will be very happy to answer all your comments. If you like this video, please give me a thumbs up. It helps me a lot. And if you want to keep watching these videos, don't forget subscribe. And if you want to keep watching these videos, don't forget to subscribe. That way you will get notified every time I upload a new video. If you want to start investing in commercial real estate, but you don't have the time or maybe the money to start investing, you can subscribe to my exclusive investor club by clicking in the link below, and I will notify once I find a deal like this. My investors start investing from $25,000 and that's completely stress-free. I manage everything. So if you want to join, just click on the link below. Hope you like this video. If you want to watch more content from me, I will leave you these videos here.